What's going on, everybody? What's going on? Back at it again. Back at it again. The market hasn't been too kind to us. The market has not been too kind to us. You see, we got very excited. I know I got very excited. I'm not going to lie to you, in August when things were going pretty well, but I kind of misinterpreted some things that were happening. And so now it's really time to put some things into context and really truly break down what's going on in the market. The last 3 weeks have been horrible for the market. The market has not taken anything that we've had going on in stride at all. So, now, it's just the opportunity for us to really truly break things down and put things into perspective. So I appreciate everybody for joining. Appreciate everybody for tapping in with another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. Please like, please subscribe. Please make sure that you share this episode. Okay. Please make sure that you like the video. Please like the video. Please, it really truly helps me in the algorithm. Okay. When you subscribe, please subscribe so you can continue to get more content from me, and hit that notification bell right next to subscribe. So every time I come on to pretty much give some game and give an episode, you can just click right there and it'll come straight to your phone. You can subscribe on there and it'll come straight to your phone, because I may pop up on a day it's not Wednesday. I may pop up on a Saturday. I may pop up on a Tuesday. You never know. So you need to be ready. Okay. You need to be ready just in case I come on. Okay. Disclaimer. I'm not a financial advisor, nor am I a fiduciary. Okay. I'm not an economist. I do not manage money professionally. So please do your own research before investing into any stock. Now, today I was planning on talking about companies, right? Because I get up whenever it's time to talk about companies. It's like people getting ready for a game. I get up for certain types of games, right? I get up for, when it's time to talk about companies. And I really truly want to talk about a company today, but we really can't do that. It's time for us to put some things into perspective again about the Federal Reserve, because we have to, right? I wanted to talk about NVIDIA. We're going to talk about NVIDIA. NVIDIA is a top 10 company in the S&P 500, a real deal, Holyfield type of company, right? A strong company, strong management, but we can't talk about NVIDIA right now. So we have to talk about how the Federal Reserve has its neck on the S&P 500, right? Because the S&P 500 has dropped substantially. It's dropped so much that all of the gains that we had in the month of August are now gone. And right now, there's a lot of negativity in the market that's going on. So much negativity. And so now this episode is really the opportunity to put some things into perspective, to understand that we can still right the ship, to understand that we still need to be long-term oriented, because we're going to hear a lot of negativity, a lot of pessimism over the next couple of months. And so this episode, we're going to break down some things that have been going on. So let me go ahead and get ready for the data so we can go ahead and share that data. So let me share my screen really quickly here. Okay, so the first, we need to talk about it, right? Because we're talking about the Federal Reserve has its neck on the S&P 500. The Federal Reserve, using their tools, right, is the reason why the S&P 500 is not moving in the way that it should move, right? So let's check this out. Fed's Mester sees benchmark rate above 4% and no cuts at least through 2023, okay? Cleveland Federal Reserve President Loretta Mester said Wednesday she sees benchmark interest rates rising above 4% by early next year. Mester anticipates the rate increases to slow economic growth, which she sees as running well below 2%. She is a Fed president. And so the Federal Reserve has certain presidents, right? Jerome Powell, he is the chairman of the Federal Reserve. And then you have other presidents around it. Like the vice chair of the Federal Reserve is Lael Brainerd, right? The Atlanta Fed president is Raphael Bostic, right? So you got other Fed presidents around here that speak a lot about the economy, right? And last week, the Fed met at Jackson Hole, Wyoming for their annual Jackson Hole Symposium. And there was some negative comments that Jerome Powell made that we will talk about in this episode. So let's go ahead and go through this article really quickly here. Cleveland Federal Reserve President Loretta Mester said Wednesday she sees interest rates rising considerably higher before the central bank can ease off in its fight against inflation. Mester, a voting member this year of the rate-setting Federal Open Market Committee, says she sees benchmark rates rising above 4% in the coming months. That's well above the current target range of 2.25% to 2.5% for the federal funds rate, which sets what banks charge each other for overnight borrowing, but it is tied to many consumer debt instruments. So, we've talked about this a lot before. Right now, the Fed funds rate is at neutral. Currently, right now, it's at neutral. It's not going to stay at neutral, but it's at neutral right now. Markets are currently pricing in a 1 in 3 chance, so a 33% chance of the Fed funds rate climbing above 4% next year. My current view is that it will be necessary to move the Fed funds rate up to somewhat above 4% by early next year and hold it there, she said in prepared remarks for a speech in Dayton. I do not anticipate the Fed cutting the Fed funds rate target next year. In line with that, Mester said rates will remain elevated for some time, a phrase used in recent days by both Fed Chairman Jerome Powell and New York Fed President John Williams. She said real rates, or the difference between the Fed funds rate and inflation, will need to move into positive territory. The Fed this year has raised rates 4 times for a total of 2.25 percentage points. Markets are pricing in a third consecutive 0.75 percentage point increase at the September meeting and looking for rate cuts to start in the fall of 2023. Mester said she anticipates the rate increases to slow economic growth, which she sees as running well below 2%. While the unemployment rate rises and financial markets remain volatile, she expects inflation to fall into a range of 5 to 6% this year. And this is a year over year number, and then closer to the Fed's target in subsequent years, right? In one concession to those looking for lower rates, she says she does not think the Fed necessarily will have to keep raising rates until inflation hits the central bank's 2% goal, but she said policymakers must remain vigilant. It would be a mistake to declare victory over the inflation beast too soon. Doing so would put us back in the stop and go monetary policy world of the 1970s, which was very costly to households and businesses. Now, this is what I want us to understand. The Fed right now is speaking to a lot of different people, and right now they are under a united front. Okay, Fed Chairman Jerome Powell came out last week, or it was sometime, I can't even remember the day at this point. He came out and he said that the Fed is going to be raising interest rates to fight inflation, right? To take care of this beast inflation. We've talked about it before. We've talked about it so much that we've had the worst first quarter in the stock market since 1970. Reason being is because of record high inflation, right? Inflation that has been so high that we haven't seen these types of inflation since 1981. And so when Federal Reserve Chairman Jerome Powell was speaking, he was saying that we need to expect economic pain. He was saying that we need to expect businesses to slow growth. We need to expect people to be losing jobs. We need to expect economic growth to not be what we expect it to be. And so that's what he was saying. And so the market did not take that well at all. The market, we have lost all of our gains for the month of August, and now we are down well below. We are now in negative territory, right? We're doing so bad right now. These last 4 or 5 days have been so bad that now the futures, we're even down again. The futures market is now predicted to be down tomorrow. So now the market just has not been performing well. But I really want to put some things into context because, like I said earlier, we're going to hear a lot of pessimism. But I will always tell everybody on the Trade for Yourself podcast that we have to have a long-term horizon. We have to be thinking about what is going to be happening in the long term, right? And so let's go ahead and go over to some economic data. Now, this economic data comes from the St. Louis Fed, okay? This is the Federal Reserve economic data. This is their website, okay? This is economic research that the Federal Reserve does a good job, okay? The people at the Fed, they work hard putting out this economic information. And so now understand, now listen back to what I said. Now, the CNBC article, what does it say? It says that she sees the benchmark rate above 4%, right? She sees that happening going above 4%. But if we look at the summary of the economic projections for the Fed funds rate, this chart that we're looking at is the projection for the Fed funds rate, or the value of the midpoint of the projected appropriate target range for the federal funds rate, or the projected appropriate target level for the federal funds rate at the end of the specified calendar year or over the long run. So if we look at this chart is giving us an expectation of what the Fed, their economic data is telling us what they believe the Fed funds rate will be at the end of a calendar year. So at the end of the year, the Fed is telling us, we're expecting the Fed funds rate to be at 3.4% at the end of this year. At the end of 2023, we're expecting it to be at 3.8%. And at the end of 2024, we're expecting it to be right back at 3.4%. Now, this is not 4%. This is 3.8% that we're talking about here. And so as far as what we're looking at from the Fed funds rate, the Fed is going to continue to raise interest rates to really, truly try to fight inflation. Now, the Fed is probably going to raise either 50 or 75 basis points. I anticipate they'll probably try to raise 75 basis points at the next meeting. The next Fed meeting is going to be September 20th through September 21st. So we're going to get some more data. We're going to get more data, and we're going to see what the Fed thinks about it. So just keep this in mind that, you're going to hear a lot of people talk about how the Fed needs to raise interest rates, and they will. Like they're going to raise interest rates, but it's not as bad as what everybody makes it seem, okay? Let's look at some other things. Let's look at the 1-year expected inflation rate. Okay, the 1-year expected inflation rate. Now, this is a measure of what we feel inflation will be 1 year from today, right? So if we look at August 2022, we're saying that 1 year from today, we believe that year over year inflation will be 3.37%. That's from the Fed. This is expected data, 3.37%. Right now, CPI is hovering around 8.5% based on the last reading. We're going to get more CPI data is going to be coming out next month in September. We're going to be getting more economic data is going to be coming out in September, and we're going to get more PCE inflation as well. Okay, this is 1 year expected inflation. So now we're at 8.5%. But the expectation a year from now is for us to be 3.38%. I think that inflation, with that being said, we can expect inflation to continue to go down, right? Okay, this is another chart. This is the chart of a 2-year expected inflation, right? This is pretty much telling us, okay, where do we expect inflation to be 2 years from today? Right now, we're expecting it 2 years from today to be 2.66%. Markedly low, way lower than where we are today. So inflation is the bear that everybody cares about. Everybody wants inflation to come down. Everybody hates the fact that the price of gas is up. Everybody hates the fact that the price of your eggs, the price of your milk, all food prices are sky high. Chicken, everybody hates it, right? But eventually the inflation is going to come down. I don't want you to be so wrapped up in the things that are going on in the interim, things that are going on in the short term over the next few months, because I'm telling you, it's going to be a very volatile period over these next 3 months. It's going to be very volatile, and we're going to go through some of the really truly some of the market risks that are going out there. But understand this: inflation will come down. Okay, inflation will come down. Me personally, like I said, I'm not an economist, but I really don't see inflation being above 10% next year. I just don't see it. You have people out there that are saying that inflation is so high, it's going to be so bad. I just don't believe it. I just don't believe it. Now, really quickly, before we go to the charts, let's check out the economic calendar. Now, tomorrow we're going to be getting non-farm, not tomorrow, but Friday, September 2nd, we're going to be getting non-farm payrolls. And so we're expecting 318,000 jobs to be added to the economy, which is lower than the 528,000 that were added. But the unemployment rate is still expected to be unchanged, right? So that's another thing too. People are expecting more economic pain. They're expecting the unemployment rate to be so high. But how much higher are we really expecting it to go with all these jobs out there? You'll hear certain economists that'll tell you, they'll say, well, you know what? A lot of these jobs out here in the economy, they're fake openings, right? Companies are going to bring those openings back. And I'm just not 100% sure that's going to happen. People are going to talk to you a lot about also average hourly earnings, right? The inflation, right? Average hourly earnings continue to increase. Now, if we see average hourly earnings decrease, that may be something good that the Fed might see. But when this number comes out, I'm expecting us to have a red day on Friday, because I don't think that the market or investors are going to see any of this from a positive lens at all. So just expect more red, expect more volatility, but that's going to help us position for the long term. Now, let's go to the SPY, shall we? Let's look at the chart of SPY. And so we're going to be able to break this down and really truly look at some things here. Now, before we get into the chart, I just want to talk about some of the market risks that you're going to want to keep an eye on, and the reason why we are so bearish, right? The reason why the market is so bearish, right? Let's look at inflation, right? People don't believe inflation is going to come down. They believe it's very sticky because of different elements in the market. Like, for example, let's say housing prices, right? Let's talk about housing. So the supply of housing, we have a low supply of housing, but home builders are not going to be building that many more houses because of the lack of the demand, right? Home builders are not building houses out of the kindness of their heart. They're building houses to make a profit. And so since we've had the housing demand decrease, right, people are now saying, oh, the housing market is in trouble. But I don't believe the housing market is in trouble. I believe that we're going to have a correction and prices are going to come in. We're going to have a retracement in terms of prices. But when people got these mortgages over the last 2 years, a lot of people were getting mortgages 3%, 3.5%, under 4% mortgages, right? When you buy homes like that with cheap money, that's not a problem. That's not an issue. And so I'm not too concerned about what the housing market is going to do. Okay, the Fed raising interest rates. The Fed is going to raise interest rates. But eventually what's going to happen is the Fed is going to raise these interest rates and they're just going to let them set. They're just going to let the interest rate set, because if we raise the interest rate 75 basis points again, that means that the Fed will have raised interest rates 75 basis points 3 times in a row. That's the highest that we've seen since 1994. I believe 1994 wasn't that good of a year for the stock market. But you want to know something else? 1995 was one of the best years of the stock market in the 90s. After all of this quantitative tightening, after the Fed raising interest rates, after all the negativity, we had some of the best returns. After all this negativity, that's what I want you to have in the back of your mind. Okay, what else are we talking about? Energy crisis in Europe. Yes, that's an issue. That's an issue because of the conflict over there with Russia and Ukraine. That's a problem. Energy bills are going to be sky high over in London. So that is a problem. But how is it going to affect America? How is it going to affect the S&P? What is the global landscape going to be? Is the dollar still going to stay high? Is the euro still going to stay low? What is the foreign exchange? Like, is the message in earnings calls, we're still saying that we can't meet earnings because of the constant currency and the exchange risk? That's a question we've got to ask. Okay, fear of open jobs going away, 318,000 jobs. Okay, that's still a lot of jobs, y'all. Like the thing that we need to look at, don't just look at the jobs, look at the average participation, the labor participation rate, and look at the unemployment rate. If that unemployment rate continues to stay low, the amount of jobs may be a non-factor. Like I said, I'm not an economist, so I'm just putting things out there because it's so negative, so negative. Unemployment rate going up. Yes, if jobs come down and people are losing their jobs and they can't find work, yes, the unemployment rate might go up. Midterm election uncertainty. Now what's happening? Now what's going on? Now we're having bickering between the Republicans and the Democrats. Who's responsible for the inflation? We're talking about student loans. Now we're getting big. Now we're bickering about student loan forgiveness. The Republicans are saying, oh, the Democrats, it's their fault these loans are being forgiven. So now we have uncertainty due to that because we really truly don't know who's going to be in charge of the Senate and who's going to be in charge of the House. S&P 500 estimates declining. So S&P 500 companies, people expecting that the estimates are going to decline. Right? That's what they're saying. And so I'm telling you, over the next 2 weeks, watch it. Over the next 2 weeks, we're going to get analyst downgrades for every single company. Watch. And the market is going to bleed. It's just going to bleed unnecessarily, in my opinion. Okay. Housing market won't be as good for the economy. Look, I understand what the housing market means to the economy. It means the GDP. I understand that. And then quantitative tightening from the Fed. So the Fed letting the assets running off of their balance sheet, right? So the Fed was raking up all of these bonds in 2020, 2021. They were printing money due to physical policy, due to the money that the government was printing. They were printing that money. And so they were buying up these bonds to be able to hold up the economy. Now they're letting those bonds run off of the balance sheet. Why? Because if we get into a deep economic recession or an economic depression, the Federal Reserve wants to have the tools available to be able to pick the economy up by its bootstraps, right? But this is the thing I want to tell you. All of this negativity, all of these things that are bad, all of these things on the horizon, it's just too negative. The sentiment is too negative. Me as an investor, the type of investor that I am, when people are too negative, I've got to shift it around for the positive, because we know that pessimism is not going to last always. When the media is putting out all of these reports and all these articles about how pessimistic the market is going to be, it's done strategically. It's done because they don't really want you to invest. They don't really want you to get assets on sale. They don't really want you buying the S&P down 30%. They don't want you getting AMD at $71. They don't want you buying Amazon at $101. They don't want you buying Microsoft at $240. They don't want you doing that. They want you to get out of the market. They don't want you holding assets for the long term. So they trick you into thinking that, hey, maybe I need to get in and out of trades to be successful. But I want you to understand, holding for the long term is going to win out over time, because you got to understand we're building wealth here. I always talk about on Instagram, I always say at the end of every post, what do I say? I always say that we've got to make building wealth a priority for our life. This is the long game. This is the long game that we're talking about here. If we look at this S&P 500 chart, yes, we're in a defined downtrend. We're in a bear market. We came to 431.73. We bounced off the 200-day moving average. The RSI was above 70. That was a clear indication for anybody that are options traders in the chat that they wanted to trade puts at this level, because we were running very hot and we were very oversold and we were not able to break that 200-day moving average. So now we've spent over 100 days below that 200-day moving average, the longest period since 2008. And so when you hear that statistic, again, I'm gonna say that again, we have spent 100 days below the 200-day moving average, the longest period of time since 2008. So guess what? You're gonna hear people that are going to discourage you about what the market can do, discourage you and say, man, you really shouldn't be buying stocks. You don't know how to invest. You don't know how to invest. You don't know how to break down companies. You don't know how to find true value. No. That's not, look, this is the Trade for Yourself podcast where I teach you how to trade and invest in the stock market for yourself. So this podcast, this platform, this movement is about debunking the stereotype that I don't have the ability to trade for myself. And so I'm just trying to, I know that I'm getting up. I know that I'm getting up for this, and I'm just really trying to just break this down and understand that we've gotta be long-term oriented here, y'all. We cannot let this noise just phase us. We can't let this noise phase us. We have to understand that we have to pick our spots and continue to keep moving towards the long term. Now, let's break down the chart here, okay? Because I've talked a lot about the risk. Let's go ahead and break down the chart here and let's see what's going on. Okay, let's see what's going on. Now, like I said before, we're in a defined downtrend. When you're looking at technical analysis, defined downtrend is a series of lower highs and lower lows. So we've been lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, right? And so since we weren't able to break above that 200-day moving average, that's a clear indication. And also the fact that we've spent 100 days below the 200-day moving average, that's a clear indication that we are in a bear market and the bear market is alive and well. Now, it's possible, and based on the negativity that's going on in the market, we can retest these year-to-date lows for the S&P 500. It's possible. We can retest these lows, and it's possible we could even break down lower than that, right? And so what I want to do really quickly here is that I want to look at the 5-year chart. I want to look at the 5-year chart of the S&P 500, and I want to draw our Fibonacci levels. I want to draw our Fibonacci levels, and I want to see where are we at right now in terms of the long-term trend. And so, whenever we're looking at Fibonacci levels, we're drawing from the all-time high and we're retracing down to that low. Okay, so we're drawing from that all-time high. We're tracing down to this COVID low because this right here is the swing. This is the big swing that we need to look at to see where we are from a long-term perspective. Now, our year-to-date low was around 362.17. That was our year-to-date low. And I believe it's possible we can retest that low and then break below it. Like we can retest the low and break below it. So when we're looking at the Fibonacci, the first thing that's crossing my mind is the 50% retracement. 50% retracement from top to bottom. That would put us at 349.54. Okay. Now that 349.54, that aligns right up with the 200-week moving average because we're looking at this from a weekly time span. So now this is the 200-week moving average. Okay, so stocks could definitely come down. We could definitely test that 200-week moving average. And I believe this right here is a massive, massive buying opportunity, in my opinion. Okay, if we retest these lows, we retest this 249 level or this 349 level, excuse me. And I've also got another level marked 339.08. That is the 2020, that's the pre-COVID all-time high. That's the pre-COVID all-time high right here. And so when I'm looking at that, that's kind of like a psychological level for me. I think that it's possible that depending on how bearish we get and how bad economic data could come out, it's possible we could come and retest this level too. And below that, Another key fib level, and this will be the lowest, like this will be the lowest of the lows, would be the 38.2% retracement level. That will be the lowest level I see us going. That will put us right around 318.83. I believe that would be the bottom's bottom. The reason why I would say that would be the bottom's bottom is because at 318.63, let me take off the fib level now, and let me kind of break it down to y'all. If we take that off, 318.83, let me go ahead and mark it. Let me mark 318. Let me mark 318, right? If we look at 318 on the weekly time frame, we've got support around that level in December 19, 2020. We got support right there. We've got a double bottom. We've got a double bottom on the weekly at that level. Okay, so that 318.62, that would be the bottom of the bottom if we did come down to that low. But the levels I believe you got to watch, 362.17, we've got to watch 349.17, 339.08, and 318.62. Now, I'm not telling you to time the market. Why? Because timing the market is better than time in the market is better than timing the market. So dollar cost averaging into the S&P is something that we need to do. We need to continue to do that every single month, right? Because the market is going to be continuously working, right? We need to continuously find companies that are undervalued and purchase them as they are undervalued. Continue to build a position, buy shares. Like, we're accumulating wealth over the long term. And a lot of times we may not be able to buy 100 shares at one time. We may not be able to buy 1,000 at one time. We may only be able to buy one at a time. Sometimes we may be able to stretch a little bit and get 2 or 3, but we're building over the long term. But now, like I said, I've always talked about the S&P. I've talked about buying the S&P because it's just so important. But I want to tell you this: if we come down to the year-to-date low and we break, and we keep breaking, and we approach some of these levels right in here, we approach some of these levels between 362.17 and 318.62. I do not want you to buy the S&P 500. And I know that I've talked about the S&P 500. We've talked about it ad nauseum. But if we get below 362.17, I do not want you to buy the S&P 500. I want you to buy singular stocks. I want you to buy singular stocks of strong companies with strong products, strong competitive advantages, strong management who are leaders in their industry, who are respected in the market, that have strong revenue prospects, strong EPS, strong earnings per share growth over the long term. Companies that are going to lead us into the next bull market. I want you purchasing those companies because those returns are what is going to pay you over the next bull market. If you're able to buy these companies way undervalued, we're talking about 10% at a discount to a 10% discount to the fair value, 20%, 30% discount to the fair value. That's what we're looking at when we get down in here, looking at how we can approach the 200-week moving average, us retesting lows. That's what we're talking about. That's giving you an opportunity to get 100% returns on singular stocks. I'm not even talking about options yet. We haven't even started talking about trading options in terms of leaps yet. This is just on shares over the long term. Like I said, that's going to pay you. That's going to pay you. That's going to make you feel good when you know that these businesses are operating the way that they need to operate. And so keep all of that in mind. Understand the long term. Understand that we've got to be in this for the long term. Please continue to research. Look, this is the time for the research, right? It's not time to just watch the market bleed down, right? This time right here, it's not time to just watch the market bleed down and just rest on our lows and say, oh, the market is just bloody. Now is the time when you see AMD down 2% on the day, when Amazon's down 1.5% on the day, When Qualcomm is down 1.5% on the day, this is the time that you research these businesses, pick your spots, understand the value, and you prepare for the long term. You continue to buy your S&P, buy your things, but understand this, like I said, when we reach the year-to-date lows and we get as low as we are going to go, do not buy the S&P 500. Buy strong quality businesses that are going to take us into the next leg of the overall bull market. So again, I appreciate y'all for tapping in again to another episode of the Trade for Yourself podcast. Y'all, please like the video. Please like the video. I would really, truly appreciate it. It really, truly helps me in the algorithm, and it helps me get this information out to multiple people. Again, I appreciate the Trade for Yourself podcast community, the family, for continuing to support, continuing to watch the video, continue to like the videos, because y'all are going to help me get out to more people so we can continue to get this message out. Again, please, if you have any questions, please reach out to me. You can follow me on Instagram, Mr. Devon Elder, MrDavonElder. You can contact me. You can ask me questions. You can email me questions at tradeforyourself22@gmail.com. You can go to the website, www.tradeforyourself.com. Grab you a couple of these t-shirts with the free shipping, and you can fill out that contact form and ask me some questions. Again, as always, y'all, don't pay for it. Trade for it. Catch y'all